If you're planning on retiring soon, you've got to consider Roth conversions as part of your financial plan. My name is Rizek. I'm a CPA and certified financial planner. I'm going to break it down for you. A Roth conversion, very simply, is when we recognize a certain amount of income by converting pre-tax retirement money to the Roth bucket. The whole point is to be tax strategic on both when we recognize that income and how much we recognize of income, because now we can fill up certain tax brackets without going into others because we're very strategic on the amount that we convert. Lucky for you, there's no income restriction or limit on how much you can convert under the current tax legislation. Roth conversions really make sense in between those years when you retire and when you're forced to take required minimum distributions, or RMDs. You'll remember that pre-tax retirement accounts like IRAs, 401ks, or 403bs have an age at which they require you to start taking distributions. Now, of course, those distributions are taxable income in the year that you receive them. For most Americans, with the passing of Secure Act and Secure 2.0 Act recently, that age is somewhere between, your early 70s, mid 70s. It depends on when you were born. Another reason to consider Roth conversions as part of your financial plan in this sweet spot window is to reduce your IRMA or Medicare Part B premiums. Part of Medicare you've already paid for your whole life as you've been working, but part of it is income based under the current legislation. And so the higher your income, the more you're going to have to pay towards Medicare coverage. By being strategic on the amount that you convert and when you convert money into the Roth IRA, you can really have an impact on reducing those Medicare Part B premiums. Again, that's because required minimum distributions show up as taxable income on your tax return and are part of the computation and formula that Medicare uses to determine how much you have to pay in retirement. So it's really not just about saving federal income tax, but also getting savings on Medicare. Let me share with you another example. If you live in a high income tax state, for example, New York or California, and you plan on retiring somewhere that's cheaper, or maybe just doesn't even have any state income tax to begin with, like Wyoming, Texas, or Florida, then it might make even more sense to do Roth conversions once you move to that state. Because Roth conversions typically also generate income for state income tax. And so you just want to be sure that you are converting the right amount at the right time and in the right place. I'm Rizek, CPA and certified financial planner. Follow me for more tips.